How business taxes work in the United States complete beginner's guide. Hello everyone. Have you ever wondered how businesses in the United States pay taxes, how much tax they owe, and how the entire system actually works? If so, this video is for you. Today, we are going to take a deep dive into how business taxes work in the United States, the different types of taxes businesses pay, the differences between small businesses and large corporations, and why some companies seem to pay surprisingly little tax despite earning billions of dollars. So make sure you watch until the end, because we'll also go through a real-life example that ties everything together. Why does the government tax businesses? Let's start with the basics. When a company earns money in the United States, a portion of that profit must be paid to the government in the form of taxes. The government uses this tax revenue to fund roads and infrastructure, national defense, police and fire departments, schools and universities, healthcare and social programs. In short, taxes are one of the government's biggest sources of revenue. Why business structure matters. Not all businesses in America are taxed the same way. The amount and type of tax a business pays often depends on how it is legally structured. The main business structures are sole proprietorship. This is the simplest business structure. If a person runs a business alone, the business income is treated as the owner's personal income. The business itself does not pay separate income tax. Instead, the owner reports the income on their personal tax return. Partnership. A partnership is owned by two or more people. The business itself generally does not pay income tax. Instead, profits are distributed among the partners, and each partner pays tax on their share of the income. LLC, Limited Liability Company. The LLC is one of the most popular business structures in America. It provides legal protection for business owners while offering flexible tax treatment. Many LLCs use what's known as pass-through taxation, which we'll discuss shortly. Corporation. A corporation is the most formal business structure. Large companies such as Google, Apple, Microsoft, and Amazon operate as corporations. A corporation is considered a separate legal entity from its owners. Because of this, the corporation itself must pay taxes on its profits. What is corporate income tax? Now let's talk about corporate income tax. If a company is organized as a corporation, it must pay tax on its profits. For example, suppose a company earns £10 million in revenue. Its business expenses total £6 million. Its taxable profit would be £10 million to £6 million equals £4 million. The company would then pay corporate tax on that £4 million profit. The federal corporate tax rate in the United States is currently 21%. So, £4 million times 21% equals £840,000. That means the company would owe approximately £840,000 in federal corporate income tax. Federal tax versus state tax. The U.S. tax system has multiple layers. Businesses may have to pay taxes not only to the federal government but also to state governments. States such as California, New York, Illinois, New Jersey often impose their own corporate taxes. As a result, a business may owe both federal and state taxes. Some states have lower corporate tax rates, while others have no corporate income tax at all. This is one reason why many businesses choose to operate in states such as Texas and Florida. What are payroll taxes? Whenever a company hires employees, it becomes responsible for payroll taxes. The business withholds certain taxes from employee wages and also contributes additional amounts itself. These taxes help fund programs such as Social Security, Medicare. As a company hires more employees, its payroll tax responsibilities generally increase. What is sales tax? Sales tax is another important part of the U.S. tax system. When customers purchase products or services, many states charge a sales tax. For example, if a product costs £100 and the sales tax rate is 8%, the customer pays £108. The extra £8 is collected by the business and later remitted to the government. The company acts as a tax collector on behalf of the state. What is pass-through taxation? Pass-through taxation is one of the most important concepts in American business taxation. Under this system, the business itself does not pay income tax. Instead, profits pass through directly to the owners. The owners then report those profits on their personal tax returns and pay tax individually. This structure is commonly used by sole proprietorships, partnerships, many LLCs. Pass-through taxation helps avoid double taxation. What is double taxation? Double taxation occurs primarily with corporations. Here's how it works. First, the corporation pays tax on its profits. Then, if the corporation distributes those profits to shareholders as dividends, the shareholders must also pay tax on the dividends they receive. As a result, the same income can effectively be taxed twice. This is one reason many small business owners prefer LLCs instead of traditional corporations. How do large companies reduce their tax bills? One of the most common questions people ask is, if companies like Amazon, Apple, and Google earn billions of dollars, why do they sometimes appear to pay relatively little tax? There are several reasons. Business deductions. Companies can deduct many legitimate business expenses, including employee salaries, office rent, equipment purchases, research and development, advertising and marketing costs. These deductions reduce taxable profit. Tax credits. Governments often provide tax credits to encourage certain activities, such as clean energy projects, scientific research, domestic manufacturing investments. Tax credits directly reduce a company's tax liability. Depreciation. Expensive assets such as machinery, vehicles, and equipment can often be deducted over several years through depreciation. This reduces taxable income and lowers taxes owed. Real-life example. Let's look at a practical example. A company reports revenue, £5 million. Expenses, £3 million. Profit, £2 million. Federal tax rate, 21%. Federal tax owed, £2 million times 21%, equals £420,000. Now suppose the state corporate tax rate is 5%. State tax owed, £2 million times 5%, equals £100,000. Total taxes owed, £420,000 plus £100,000, equals £520,000. In this example, the company would pay approximately £520,000 in combined federal and state taxes. Conclusion. The U.S. business tax system is large, complex, and multi-layered. Businesses may be responsible for several different taxes, including corporate income tax, payroll tax, sales tax, state taxes. The business structure also plays a major role in determining how taxes are calculated and paid. This complexity is one reason why accounting, tax planning, and financial advisory services are such massive industries in the United States. If you enjoyed this video, don't forget to like, subscribe, and leave a comment telling us which country's tax system you'd like us to explain next. Thank you for watching, and I'll see you in the next video.